Alright, welcome back. So in video one we already discussed how to mark the key levels and how important key levels are for volume and and for targets and for execution. And then in video two we already covered how to do channel lines. We also and then we also discussed that you can enter at the key level, etc., or you can enter at the channel lines. However, you might have missed those entries, uh, and then you want to join a trend subsequently, some days after, or a next day after, or how many days it is. So there are a few tips on how to join an established trend. Okay, and uh, but first thing is that you, of course, you distinguish what the overall direction of the market is via the trend analysis and the channel lines. So, for instance, but we've missed the channel entry and we've missed the key level entry. So, like today is Monday, so we need to find an entry on NU. So, I'm going to give you an approach on how to do that. So, we're going to use some indicators to help us to plot an entry, a planned entry later on NU, and I'll show you how to do that now. Alright, so first let's add an indicator. The first indicator we'll add is pivot points. Okay, I'm not going to go into a detailed description of pivot points on this video, but I'll show you how to use them. If you can imagine that you want to enter a trend, it's already begun. Let's say the trend already begun at this channel line, and you missed it. So how can you enter? Well, how can you plan your entry? So let's go to a smaller time frame. Look at the daily for today, and I'll tell you what I want to see. Daily pivot point here. Okay, I want to see the market gap up, fade back to this pivot point, and I'll execute a trade. So I'm going to put a buy position here, which is buy at limit. I'm going to add a stop loss of 20 pips, which is added. Okay, so my trade plan here against this range is to wait for the market to gap down to the pivot point and try to get an entry, assuming that this is the first day of breaking out of the range. So we broke out, we retested it. I'm going to assume that the market will retest this range, retest down here at the pivot point, and we can get a buy. If that fails, we could look at an S1 entry, or we can look at selling off this range, right? But today I'm going to go for a potential buy at the pivot point. Okay, so if you want to look at this in history, you can see that the market, this is one day, between here and there is one day, and that's what we call the daily pivot point, this line. As you can see on the current day, it's projecting price, okay, at the daily pivot point. So I want to see market gap up and fade back to this pivot point and pick up my entry there. So for example, you can look at how this played out in history. You can see market gaps up above the pivot point, fades back, hits the pivot point. That day didn't fade back for the pivot point, but that's one good entry, and if you had that, you would have captured that move. We go back in the past where the market's trending, and you can see market gapped up above its daily pivot point, pulled back. You could have got an entry on that day. Market gapped up above its pivot point. You can see an old entry here which was pending. If that was a bit higher on the pivot point in the past, I would have picked up that entry right here. Yeah, so again, market gapped up above the pivot. You can see it gapped up and then pulled back to the pivot point. So this is a very simple way of using pivot points in a trending market. So obviously you're not going to get the move every day, but some days you get it spot on. Gaps up, fades back. Gaps up, fades back. Gapped up, faded back to the pivot point. Yeah, So that worked out really well. And even that did, if you look at it on a micro point of view, you see it gapped up above its pivot point and faded back for a good buy. So that's one of the moves that you want to capture, is a gap up from the pivot point and a move back. Now, if you're not using the pivot points, I'm not going to give you a really descriptive look at the pivot points. That is something that we can do later on. But let's imagine that we can't get a pivot point entry. We could also use a moving average. So to do that, we just pull up a moving average, which is average price. Let's look at the 200 moving average. Okay, so here you have confluence, right? So you can say, okay, I'm above the pivot point and I pull back to the 200-day moving average, okay? And this one I pull back to the pivot point and I'm on the 200-day moving average. So execute a trade there. You could, I'll give you an example what I'm trying to show you. There you go. You want to execute a trade on the 200 at the pivot point. Then you want to execute a trade at the 200 at the pivot points. These are pivot points. Okay. You could even execute a trade a little bit later on if you wanted to, which would be about here. You can see, right here you got another chance here. Gapped up, faded back, execute a trade. Here. Going a bit flat. You want to see the 200 moving average sloping upwards. Yeah, now you're flattening out, so it's not very comfortable to get that one. But you could give it a go, but you'd probably get stopped here because it's smoothing out. But then you wait, start bending upwards. This is something that we'll cover later on. This is called a breakaway play, when you've got inside value of 2 pivot points. But we won't discuss that now. What we're trying to do is just stay on the moving average pullback where we can buy again. So, or pull back to the pivot point. Okay, missed it on that day. That's the following day. Okay, and now we're at current market. You would have got it on that day. You got a nice pullback to the pivot point. You see, you gapped up above the pivot. You faded back, so you could have bought the pivot point there. Should have a great trade. Gapped up, faded back. Missed it on that day. You missed it here. You got a gap up, but there's not really. This is a market open time. Your spread would have been probably not. Would have encouraged you not to take the trade because spreads widen when the market opens, and then eventually you fail here, you fall through, and that's over. Okay, so also that's using a 200-day, right? You can go to a smaller moving average. So you can edit this and you can smooth it to say a 50, and then you can have more aggressive entries on a 50-day moving average. Okay, price above the pivot point, gaps to the moving average, you can buy it. Price gaps above the pivot point, you look to buy the pivot point or break off the moving average. Price gaps up above the pivot, fades back, you can buy it. If you want to buy at the moving average, you can do it. Okay, same here, gap to the pivot point, confluence, 50-day, touch of the 50-day moving average. You could have bought that if you wanted to. Touch of it, because it's still sloping upwards, right? Price is still trending up. And this is assuming that you missed the channel entries. And you've got another one here, you're gapping up above the pivot, you've got another entry there, touch of that. Then it starts to smooth out, you need to be out and not in the market, okay? Because that's telling you that average price is going from bullish to bearish. Okay, so that's one tip on how to enter the market if you missed key level entry or you missed channel line entry. So you've got a good technique is to use moving averages and the pivot points. All right, that concludes lesson 3. Thank you very much, guys.